All right, let's dive right in. Today, we're talking about a strategy that's all about bringing some much-needed order to the absolute chaos of the markets. If you're a day trader, you know exactly what I'm talking about. I mean, that's the big question, isn't it? You've got prices flying all over the place every single second. How in the world do you make sense of it all and actually make good decisions when the pressure is on? Well, here's the secret. It's not about having some magical crystal ball that predicts the future. Nope. It's about having a tool that helps you see what's happening right now with way more clarity. It's about filtering out all that random noise to see the real trend underneath. Look, day trading is a game of speed. You have to make decisions fast, and they have to be accurate. To do that without just guessing, you need some kind of framework. You need a way to give structure to that wild price action. So let's check out a really simple but incredibly powerful tool that can help you do just that. The solution we're going to unpack today uses a specific combo of 3 simple moving averages, or SMAs. We're talking about the 5, the 8, and the 13 period. Now, these numbers aren't just random. They're actually from the Fibonacci sequence, which is a big reason why traders love them. It's a visual setup that really shines on those lower time frames that day traders live on, like the 1, 5, or 15-minute charts. So what even is a simple moving average? The easiest way to think about it is as a smoothing tool. It just takes the closing prices over a set number of periods, let's say 5 minutes, and gives you this constantly updating average price. It helps you see the general direction, the trend, without getting all bogged down by every little tick up and down. Okay, this is where the magic really happens when you put these 3 SMAs together. I love this analogy. Think of them as 3 momentum lanes. The 5 period, that's your scout. It's out front, reacting super fast to price changes. The 8 period is your core trend, kind of showing you the immediate momentum. And that 13 period, that's your foundation. It's the slowest, the most stable, and it's there to confirm the bigger picture. So how do these so-called lanes actually tell you anything useful? Well, when they start to line up in a very specific order, they paint an incredibly clear picture of a strong, tradable trend. And this combo, it doesn't just show you the trend, it gives you the whole story. You can literally see momentum shifting when the fast lines cross over the slow one. You get solid trend confirmation when the price is respecting all 3 averages. The space between the lines tells you how strong the trend is, and they even start acting like moving support and resistance levels. And the best part? This works just as well for downtrends as it does for uptrends. And here it is. This is the exact visual you're hunting for. In a really healthy uptrend, these lines stack up perfectly. The fast 5 period is on top, the 8 is in the middle, and the slow 13 is on the bottom, all of them sloping nicely upwards. And if you're looking to short a market, you just slip it. In a strong downtrend, the 13 is on top, then the 8, then the 5, all sloping down. It's the same beautiful, clean logic, just in reverse. And this isn't just theory, right? It plays out in the real world. In one example from our source material, a super clear upturn signal on the QQQ identified by this exact SMA stacking led to a 2.64-point move. It just goes to show how a simple visual pattern can point to a very real, tangible opportunity. Okay, but this right here, this might be the most valuable thing this strategy does. It doesn't just tell you when to trade, it tells you when not to. And honestly, knowing when to sit on your hands and just protect your money is probably the most important skill any trader can learn. So the whole game is learning to spot the difference. Over on the left, you've got that clean, trending market. The lines are orderly, spaced out. That's a green right. But on the right, oh man, that's a minefield. The averages are all tangled up, a knotted mess, moving sideways. The price is just whipping back and forth across them. That's not an opportunity. That is a massive warning sign screaming, stay out. And that really gets to the heart of this powerful idea. Staying out of a choppy, messy market isn't a missed opportunity. It's a strategic decision. It's capital preservation. And that discipline is what builds the foundation for being successful in this game for the long haul. Now, we have to be super clear about this. This is a fantastic tool. It really is. But it is not a magic formula. It's not a crystal ball. Like any technical indicator out there, the 5-8-13 SMA strategy has its limits, and you absolutely have to understand what they are. Okay, so there are 3 main things to always keep in your head. First, all moving averages are lagging indicators. That means they confirm what's already happening, they don't predict what's going to happen. Second, they can totally give you false signals in those choppy, sideways markets we just talked about, which is why recognizing them is so crucial. And finally, you should never, ever rely on just one tool. This has to be part of your bigger analysis.
So to wrap this all up, what's the big takeaway? Think of this as your visual framework. You need to pair it with other things like volume or price action to get confirmation. Really study how the price reacts when it gets near these moving averages. And above all, learn to spot those choppy danger zones and tweak this whole approach so it fits your own trading style.
Which brings us to our final thought here. The real skill in trading isn't just about finding that perfect entry. It's about having the discipline to see a bad setup and just walk away. This strategy gives you the visual cues to do just that. The only question left is, can you develop the discipline to actually listen to them?